Hi, this is Michael Jordan, and I am going to follow up on the information that I said that I would share concerning life insurance in the Negro American community. One of the first things that I would like to discuss is the attitude and understanding that people have as it pertains to life insurance. Most people erroneously look at life insurance as a mechanism where if they die, someone gets a benefit and they have no control because they're dead. Well, that's partly true. And one of the things that we want to do, we want to dispel any half truths that people have so that they can understand the real power of life insurance. So, does life insurance protect the people that you love? Correct. So, when you hear anyone say, well, why would I get life insurance and leave something to him or her to benefit them and so they could live a better life? That's an entirely different dynamic and something that people have to work through. So, what I want you to understand is this: many people in the Negro American community do not own homes. Okay, this information is for everyone. Listen to what I'm sharing. This information is for everyone, and people have been using life insurance for over 200 years to transfer wealth. That said, I'm speaking specifically to the Negro American community right now. And we don't own homes for the most part. We're not homeowners. So, what other means do we have to pass on wealth to our offspring? Okay, so because we don't have any other mechanism, then it stands to reason that we're going to want to take a very good look at life insurance and how it can benefit us now when we get older and benefit us and our children and our designated heirs when we pass away. So, how can life insurance benefit us now? Well, it depends on the life insurance you get. And so not all life insurance fits every person. Case in point, if you're in your 80s, you're not going to be able to get a life insurance policy that's going to pay out a $500,000 policy, death benefit. It's not going to happen because you're in your 80s. And your life expectancy is not that long to be feasible for the insurance company to insure you for that high of an amount, understanding that you're not going to live that long and the premium payments are not going to be that much. That's the way the game works. Okay. So, with that said, there is a benefit for life insurance for someone who is in their 80s, and that is for either that person and or their loved ones, whether it's an individual or a group of individuals, to combine their resources and pay for that policy for that person in their 80s in the event that they do pass away. And at the very least, they can have coverage to cover the death benefit. So that's one aspect of how life insurance can help. It can help unburden the survivors of someone who passes away. That's number one. And it can be done very reasonably. Number two, the accumulation of wealth. How is life insurance used to accumulate wealth? Where it's very simple. As I said, not all life insurance is the same. So you have the Index Universal Life. Now, Index Universal Life is something that the younger you get it, the least expensive that it is. So that means that if you're currently in your 20s, 30s, 40s, 50s, this is something that can benefit you greatly, because not only can you pay for the death benefit portion of the life insurance, but you also get a cash component that's going to grow as you pay your premium on a monthly basis. And you can actually start a small IUL with as little as $100 per month. And that will actually give you the benefit of starting, first of all, you can get your guaranteed insurability. Secondly, you will start building toward your retirement, building your wealth. And thirdly, you will already have insurance in place in the event that you want to increase the policy amount as your income grows, so that you can actually put more money into your IUL. Now, that's insurance for younger people. What has happened in recent years is that those index universal life insurance policies have also come with, some of them, not all, come with what's called riders. And what those riders do, you have a critical illness rider, you have a chronic illness rider, you have a terminal illness rider, and then you have a total disability rider. And what that does, it pays you 80% of the death benefit. So if you have a $500,000 death benefit, it's going to pay you 80% of that if, in fact, you become critically ill, chronically ill, terminally ill, or disabled, and you're not able to perform 2 of the 6 daily functions of life. So that is the IUL, and that's for people within their 20s, 30s, 40s, and 50s, and they're trying to build. There's a lot more to this and how it works, and that's something that can be discussed at a later date. Now, the third aspect is the wealth transfer. So as your cash component of the life insurance, the IUL is starting to build, and you get to the point where you have X number of dollars, and now you're living off of that income. You're taking it out smartly, and your monthly distributions are in keeping with having that lifetime income. Well, if you never need to use any of the death benefit, and you have increased the death benefit in conjunction with how much you earn, what you've done now is put your offspring in the position, or any one of your designated heirs in the position, to reap that benefit in the form of a tax-free distribution, a inheritance-free distribution, a capital gains-free distribution. Now, understanding this, all of these life insurance policies are growing at a rate that is non-taxable, because you are putting post-tax dollars toward this life insurance. This isn't pre-tax, where the tax is being deferred. This is post-tax money that's growing tax-free. And when you start to get your distributions, they're tax-free as well. So this is some of the information that I wanted to share, building up to more specific topics and conversations about how you can actually apply the index universal life and the fixed indexed annuity. Now, the fixed indexed annuity are for those individuals who are in a different situation. So either you are older and you don't have the luxury of getting the IUL because of health problems, but you still have the income, post-tax money, or, well, let's just deal with the post-tax money first. So if you, let's say, for instance, you're a gamer, or you do some type of NFTs, or you're in crypto, or however, and you're making a substantial amount of money per month, well, you're going to pay taxes on that money anyway. So a portion of that money you're going to want to put into a fixed indexed annuity if you cannot put it into an IUL. And again, there are different fixed index annuities that put you in a better position. But the thing that you can rest assured and comforted in is that the IUL and the fixed index annuity have a guaranteed no loss of principal. So any money that you put toward your retirement or growth, you're not going to lose any of it, guaranteed. And so the second aspect of the fixed indexed annuity is for people who are currently in a qualified plan being a 401k, 401b, IRA, Roth IRA. Even though the Roth grows tax free, you're still going to pay taxes on it as you're taking the distributions. When you are in the 401ks and the 403bs, in those types of qualified plans, you are not only is your money at risk, but you're going to pay a lot in taxes as that money starts to grow, and you are going to take the distributions later on. So what we do is roll people in those qualified plans into an appropriate fixed indexed annuity, which will give them the security of knowing that they're not going to lose any of their principal and that their money is still going to grow for them. And of course, it's because it's still being tax deferred, they're going to pay some taxes on it, but it's going to be a less amount of taxes that they would pay otherwise. And that's something that you're going to want to discuss with your tax person, and something that we can actually get into, that you can get into with the life insurance retirement specialist that you're going to speak with. So we've covered the IUL, we've covered the fixed index annuity, and we've covered who they're for. So that fixed indexed annuity, again, is for people who are older and can't qualify for the IUL, or for people who are getting a windfall from any type of work that they do, whether it's gaming, whether it's cryptocurrency proceeds. Those you're going to want to put in a secure situation where it can grow, and you're going to pay taxes on it anyway. So you might as well move that money once you've paid the taxes on it and put it in somewhere that's going to grow tax-free. And then for older people past 55 who don't have the luxury of purchasing the IUL and using that as their retirement vehicle and their wealth transfer vehicle, then the fixed indexed annuity is something that's great for them. And there are, as I said, different types of fixed index annuities that actually pay you more, but there's a greater cost of entering into those fixed indexed annuities. Right now, you can enter into IUL, Indexed Universal Life Insurance, with as little as $100, and you can enter into a fixed indexed annuity with as little as $100. And we're talking post-tax money. So I hope this helps. I hope this gets you interested in the information that I'm going to be sharing about specific groups of people and how you can actually use life insurance to build your current wealth, to build your retirement wealth, and also to transfer wealth to your designated heirs. Thanks.